welcome to this edition of Low Country Money Talk. I'm Lisa Richardson, and always good to have Phil Bloyd here with us from the Revolutionary Financial Group.
Hey, that's a mouthful.
That's a mouthful. Well, we've got a lot to talk about today,
Yes.
and I know everyone is wondering what's going on with the economy. So we're going to start off with a report from the Managing Director from the International Monetary Fund and see what she's going to predict.
Yes.
1/3 of countries around the world, this is the 1/3 share of the world economy, would experience at least 2 consecutive quarters of contraction this year and next year.
So we're talking about the world economy.
Yeah. So, the thing on this, Lisa, is this won't go away, it seems like. So in 2008 and 2009, we've kind of bottomed out the market, got it to its end, and then moved up from there. This just keeps going and going and going. So we've had 2 back-to-back negative quarters as far as GDP is concerned this year. The last quarter that was reported was positive, but she's actually talking about the world, and she's talking about next year.
Okay.
So this is something, that's going to be around a while, and we've had a couple, 2 or 3 big rallies lately, but they don't hold, and then everything goes back down to where it was before. So for retirees, it's going to be a challenge. There's a few more clips. I know the accent is tough, not mine, but hers.
Yeah.
So let's go ahead and listen to a few more of those clips and see what else she has to say.
Let's do it.
I'm the natural optimist, but today I stand in front of you and I need to say more likely to get worse than to get better. In other words, risks are, as we say at the fund, on the downside. We are further downgrading our growth projections for next year, and we will be flagging that the risks of recession are rising.
Well, Phil, I guess it's not as positive as we would have hoped. So we're talking about it
sure.
getting worse and a recession.
Right. So, Lisa, a lot of people thought we were already in recession, right? And technically, most, if not all of my life, and, I'm a young 35. I know I've aged a bit, but my years in the Marine Corps, you age 3 years for every one, they say. But the thing being is the way that we've always looked at it, are we in a recession or not, is 2 back-to-back negative quarters of growth. And we already had that behind us. So she's talking about next year now. And a lot of people that say, well, we're not really in a recession in 2022 because the job market's good and all this stuff. Okay, but there's even those people are saying, well, next year we're expecting a recession. So if they didn't acknowledge that, we had the 2 negative back-to-back GDPs and we were in a recession this year, and this was not a good year for investors.
No.
I'm only wondering what they mean for next year.
Yeah. Wow. Well, how might that look at an average person's, day to day? Let's talk about prices of
Sure.
gas and food and just the day-to-day things that we all need.
That's the things we talk about, Lisa, is like, look, you can call it what you want, but when you go to the gas station, when you go to the grocery store, you're paying more for everything.
You are. Someone who shops a lot, I do see the increase over the last year. I mean, in a lot of cases, it's double per item.
Eggs, I think, 3 times the
Eggs,
cost.
yes, you're
we
right.
can get a steak and forget the eggs.
Yeah,
Okay.
yeah, right.
I'm like, wow, and this is a staple that most Americans have in their diet, eggs, this and that. So your grocery bill is probably, one of the big things. And now we're going into winter. So we have utility bills and things of this nature, and they are expected to be 50 to 100% more.
For heat and gas.
So people know. They're like, look, everything costs more. My values and my savings are down, and, the dollar doesn't go too far. I heard recently some of the politicians were claiming, hey, we got you a raise in your Social Security, because Social Security is going up 8.7%. Those politicians got you a raise in their Social Security because they put us into inflation.
Yeah.
Because your Social Security is adjusted by inflation. It's automatic. So the politicians, what they had to do with was getting us in this inflation by spending too much money.
Yes.
There's too many dollars following too little goods. That's the definition of inflation. And we can talk about recession and we can talk about this or that, but inflation is a killer.
What do you, in your expert opinion, see happening? Now, we're going to talk in the next segment about retirement,
Yeah.
looking at retirement, but just for someone who's not there yet, someone's
Yeah.
working families, what do you advice might you give
Well,
them?
the interest rates going up by the Federal Reserve,
another thing,
if you
yes.
haven't taken your retirement options yet, we'll talk in the next segment, but that's
Yeah.
going to affect you big time.
Wow. Wow, there's a lot to learn here. Very important information. So stay right here. We're going to be back with another segment here from Low Country Money Talk. Welcome back to Low Country Money Talk, and Phil is explaining a lot of really good information that all of us are wanting to know. We talked about retirement coming up. If someone is in that stage where it's, hey, it's about time for me to retire, I'm looking at the economy and I'm wondering, what do I do? How is this affecting those
Right.
people's thought process?
You know, Lisa, the best way to make sure that we're ready for retirement is to never let the stock market dictate to us. But
Yes. Never
if I
let it
haven't
get you up
known
and
you
down,
that
quite
long,
literally.
the problem is, though, many people, you know, they're past that.
Yes.
You know, they didn't get the help early on. So let's say that I had a client and I got to know them and they became a client maybe 10 years before their retirement date. We would not we would not be in a position to let a down stock market determine whether we're going to retire or not.
Yeah, that's true.
But, you know, most people aren't in that position. So when everything's going well, people don't pay a lot of attention to things.
Right.
When things are going awful or a little bumpy, then people pay more attention. So obviously, I'm getting a lot more interest where people are calling the office, they're coming in and all this because the market is just so torn up and most of them are already retired and they're losing a little bit too much and they're concerned, as they should be.
Yeah.
But what we were talking about in our last segment, we were taking more of an international look at things. You know, we had the nice lady with the Slavic accent.
Quite an
I
accent,
guess,
yes.
talking to us about, you know, the worldwide situation. You
Sure.
know, we're a big part of that world, so we're going to face the same thing. The problem that we have here is the rising interest rates through the Federal Reserve. So Chairman Powell mentioned he's the chairman of the Federal Reserve. They're in control of our monetary policy. And he said, okay, by the end of the year, which is
Coming up.
almost here, that he would expect federal fund interest rates to be at 4.5%. So we've got about 50 more basis points or 0.5% to go. So they just had their last increase, which was 75 basis points or 0.75% for regular people to understand. Some of you can't understand those people when you listen to them. So I want to try to make it where, you know, we're speaking English somewhat.
Sure.
But he said 4.5. I'm going to take him at his word. Okay, so that means another 0.5% in December. Now, in January, many people are saying that rate will go over 5%. So just a short time back, that rate was basically 2% or less.
Right.
So here we are. The problem is these rate increases and all this aren't really slowing down the economy much. So I don't know, maybe it takes a little bit longer. Maybe there's a bubble in the line and all of this stuff. But the problem we're going to have is those that aren't retired yet that have a defined benefit pension plan. And because those are based upon what the federal fund interest rates are. And most people think, hey, I'm going to take a lump sum for my retirement. I'll put it in my IRA. I'll invest it.
Yeah.
Okay, so the problem is you think, well, the interest rates are going up 5%, so I'm going to get a bigger lump sum. Wrong. It goes down.
Oh.
So here's one thing that people are thinking incorrectly on. So if you're close to retirement or getting close, you need to get to your HR or whoever has your pension numbers, and you need to look at your lump sum. You need to look at your monthly as far as your annuity settlement on your pension and see what they're offering. Because if interest rates continue to go up, your lump sum, if you were considering that, will go down.
Oh,
it
wow.
won't go up, it'll go down. And 1% interest can make a huge difference in that. So you first of all, if you're thinking, oh, interest rates are going up, I'll get more of a lump sum, you're thinking wrong, because that's actuarial, not how it works.
Wow.
So we don't want to be sucked into making a decision with bad data.
Sure.
So if you're getting close, go check your numbers now.
Yeah.
And then you may want to delay until interest rates come down. I don't know what your situation is, but
Well, if someone's sitting here thinking, how will will my money outlast me?
Right.
What do you say?
I say go to our website and download a booklet, because we have one available on that exact subject. So, the contact information is in front of you. Go to our website, download that booklet. There'll be opportunities if you have questions. We can follow up with you there.
That sounds great. We're going to be right back with more Low Country Money Talk. Stay right here. Welcome back to Low Country Money Talk. Always learning so much very valuable information from Phil here from Revolutionary Financial Group. So in our prior segment, we've talked about if you're considering retirement and lump sum. So if someone's already taken a lump sum, they've got that in their account, market's going down, looks like is money going to work last? What are we talking about now?
Oh, a lot of things, Lisa. So in the past, we always talk about buckets of income, where to take our money from. So first of all, if we don't need to take money from our stock market side of our accumulation or our savings or our portfolio, let's stop that now, because that side is going down, on average 22% is what the S&P 500 is down. So let's not take income from something that's depleting in value first, okay? Because if we take water out of a bucket that has a big hole in it, it'll get empty faster.
Yeah.
That's technical.
Yeah.
Technical terminology.
With the hopes that will shift and it'll change.
Okay, so what we need to do first, if we're under 72, we're not required to take anything out of our IRA.
Okay.
So if our IRA is invested in the market or part of it and we're not required to take it out, and we have other funds that we can draw from that's already been taxed, like savings, checking, whatever, and we're not getting much return. Let's take that money first.
Or any hardly at all, really, quite honestly, right?
A lot of people have
Point.
way too much. They have way too much in their checking and savings.
Yeah.
And in their mind, they're thinking, well, I feel comfortable if I see X amount of money in my checking or savings.
Yeah, I'm one of those people, have to be honest.
Stop it. Well, see, that's going to hurt us in an inflationary environment because we're not getting a return on that. Okay, so
Right.
if we have $100,000 in checking and we're getting a 0% return, and we're at 8% inflation, by the end of the year, it's worth $92,000.
Yeah.
Okay, so the first thing we want to do, though, is if we're not required, because if we take it out of an IRA, not only we're losing because it's down in value, 20% or so, how much do we have to pay the federal government to take withdrawals from our IRA? So that could cost us another 20%, right? So now we're down 40% to get this dollar. So this dollar out of the IRA, because of inflation, we'll say 8%. Because of the market went down 20%. So now that dollar is down 28%, but then we add another 20% for taxes. So we take $1 out of our IRA, maybe it's only worth 52 cents, okay? Now, I have $1 that's in my checking account. I have way too much money in my checking account, let's say. How much do we have in our checking account?
Are you asking me?
Yeah.
I'm not going to tell you.
Okay. We should have about 6 months expenses.
Yes, of course. Emergency
Expenses, okay,
Yeah.
not pay, but expenses for your emergency, okay?
Yeah.
All right, so I've got 5 years expenses in my checking account. So first of all, if we take $1 out of there, maybe we're only losing the 8% to inflation because we've already paid taxes on that money, right? So would you rather lose 8% or would you rather lose 48%?
Well, clearly the 8, right? Yeah.
So that if we can take money that way, that's the best. Other people, they may not have that excess in their checking. So then we have to see, do we have other places that we can take money from that is more tax friendly, especially when we're in an inflationary period.
Yeah.
So we've got to figure that out. Too many times people just reach for the IRA and say, well, that's all where all my money is. I'm just going to take it from there. And I'm like, why would we take it from there? Because if we take it from there, we lose money from taxes, inflation, and market downturn. So let's not do that, first of all. The one thing that we like to do is we say, hey, come in, let's take a look at your portfolio. Let's go over where we can take our money from more efficiently so that we lose less. Because most retirees, they need to transition from, let's say, financial planning to distribution planning.
Yeah, that's a good point.
Yeah.
And I think it's also worthy of mentioning, we were talking, it's important to remind people not to panic, but just to be proactive.
Yeah. Well, once we get involved in the process and we take control over it, we empower ourselves and we're like, yeah, we know this is a problem, but we're, instead of ignoring it or saying, hey, it's going to get better, we grab it and we develop a strategy and a plan and say, hey, this is how we're going to knock it out. This is how we're going to deal with it. And if we just sit back and feel helpless and let it come to us, usually doesn't work.
So we've been talking about retirement and what to do, and so we would like people to know that they can please call in to receive their complimentary portfolio analysis.
And Rachel will be the one that kind of gets back in touch with them on that. So.
All right, get a hold of Rachel. But you all stay here. We're going to be right back. Welcome back to Low Country Money Talk, and we've been talking about retirees and retirement, but what about the folks who are maybe a step back from there? Maybe 15 years is ahead from now is what their time frame is. What advice do you have for those folks?
Young folk. Yeah.
Kind of young.
Well, first of all, you need to make sure you're saving enough. Save first, spend later. So,
of course.
If we're at a place they're offering a 401k or some matching, we definitely want to take advantage of that. Because, if your employer is going to match your 401k and you're like, oh, I'm not interested, I'm like, that's free money, you should take it, right? So let's do the matching. When you're working, you're automatically, you're getting paid twice a month or whatever. You have money withdrawn from your check that's going into your 401k, so whatever investments you choose. Okay, the problem and some of the things I'm concerned in this market is, let's say we've been working a long time and our 401k has just ballooned to a large amount. I had a person come in and they're like, well, Phil, I don't really try to time the market and this and that, and I just invest, and it's up, it's down, it'll all work out. Well, I'm not as worried if you're working about the monthly payments, because those are dollar cost averaging in. So when the market's up, you're buying at a higher price. When it's lower, you're buying at a lower price. But if I have this big amount of money that I've already accumulated, that's where you're going to get your biggest slam from this market.
Yeah.
So the big accumulation amount is going to be down about 22% so far for the year. And what history tells us, I'm just going by history here.
Sure.
I like history. I had a great high school teacher, to college, all the history in college. I really believe in history because it repeats itself. So we can learn a lot of things. The stock market history tells us when the Standard & Poor's 500 index, which is a benchmark of the overall stock market and how it's performing, even though they hit us with the Dow every day, that's only 30 companies, the Dow Jones Industrial. The S&P 500 is 500 of large capital companies in the U.S. So that gives us more of what history tells us, Lisa, on that is that in a bear market, that index is going to go down 35 to 40%. So let's go back.
Yeah.
I'm 15 years out.
Okay.
I'm dollar cost averaging, so I'm like, it'll work, but I have a huge lump sum that I've accumulated over the years that is down 22%, okay? Because I'm like, I'm young, I need to be more aggressive, okay, so anyway, we used to call it the John Wayne. Okay, so anyway, that's all accumulated. Well, that just took a huge hit.
Yes.
If you're on a railroad track and you see a freight train coming, are you gonna stay there?
No.
Well, that's my problem. So I'm sitting here looking at this lump sum thinking, hey, on average in a bear market, it's going to go down 35 to 40%. We're down half that now. I'm just going to eat it and take the next step down. No.
Okay.
So we need to look at that 401k, look at the options, be more protective with the lump sum The monthly average is maybe not as much because time may settle that out, but we want to make sure that we protect a big part of it.
Sure.
So that we're ready, because here's the other thing.
And how when you say protect it, what are your advice then? Where would you
Well,
put it?
it depends on what your choices are in your plan. So you're going to have some lower risk type plans, maybe even some money market. We need to move that. The bigger portion, I would say, instead of exposing that to that next 40%, is I would pull that back, and maybe if you're like, well, gee, I'm not trying to guess the market, you can always pull that back and dollar cost average it back over the next 12 months, 24 months, whatever, so you don't take that big hit.
Just maybe move it into less risky.
Yeah, that's
Okay.
what I'm thinking.
Gotcha.
Because who wants to if history repeats itself, that's going to go down another 20%. Who wants that?
Yeah.
Yeah. And it's the big lump sum amount, or the bigger part that's been saved, that I'm more concerned about than the monthly, contributions.
Yeah.
Because if I see that freight train coming, I'm gonna say, I'm gonna pull back and take a little breath here. I can always invest it back in, but if it's gone, how much are you gonna put back in?
Yeah.
Because it's down.
Yeah. This can be a little bit frightening, a little bit scary for people. So, but we don't want them to do that. We don't want you to panic. Definitely be concerned, but be proactive, and that's where you can help.
Yeah.
And that's where they can get called to get their complimentary portfolio analysis.
Yeah, and it's important because, the one thing, I'm a military person. I did over 13 years in the military. The thing we want to do is we want to develop a plan and take control.
Yeah.
And then we're gonna feel a lot better. We'll relieve a lot of that stress.
Yeah. Well, so good to talk with you. Always very informative,
Yes.
and we hope that you have enjoyed listening today to Low Country Money Talk.